This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
If you thought making money on real estate was just for big spenders, you're in for a surprise. There are investments out there that require very little cash up front, yet have the potential for outstanding returns. Where are they? How do you get hooked up? Visit jasonhartman.com. You'll learn everything you ever wanted to know about investing in real estate, but were afraid to ask. You'll learn about the best areas for cash flow, how to make money with tax-free income, how appreciation works, and more. You can even see how to get back the taxes you've paid for the last 5 years just by investing in real estate. Visit jasonhartman.com.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome, empowered investors, and greetings from beautiful Tokyo, Japan. Got here just yesterday, and it's my third time in this city. I love Tokyo, love Japan. You probably heard me say that before. It is the most civilized country on earth. Just such a great place. It's really great. But it is chilly right now. It's quite cold, and this is a very difficult place to do business with the West. So I'm glad to say I will be leaving Southeast Asia next week, and on my way back to the good old US of A, I can hardly wait to be in a better time zone because it's pretty hard to be productive over here. Because you folks, well, I know we have listeners all over the world, but most of you are in the Western Hemisphere, and you folks like to sleep when we're awake, and the opposite. So that's the way it is. Hey, I've got something here for you. I want to play a short clip from a quickie little short video. And it relates back to what we were talking about just a couple of weeks ago, and that is the Refi Till You Die segment, because it talks about how wealthy people use money, how they don't pay tax on income that they don't show and they don't have because they try not to have big income. Oh, by the way, if you're watching on video, I must just comment here, this is now our second bathrobe show. Yes, it is. That might want to get some of you watching on video if you're only listening on the podcast. I won't be doing these bathrobe interviews much longer because I will be back in the US and I'll have a much more normal time zone, but it is almost midnight here in Tokyo. So that's that. And I really like my viewers and my listeners to just tuck me into bed. Okay, here we go. This is an interesting point, and it starts off, I don't know if you'll be able to hear it right in the beginning, with the announcer saying that if you have no income, you don't pay tax, right? Because the best way to structure your income, the most tax efficient way to get the wealth out of your real estate portfolio is to simply refi till you die, to use my strategy that I've been teaching for 21 years. And this is another example of how wealthy people do exactly that. Here we go.
You don't pay any tax. This is exactly what wealthy people are doing.
Elon Musk never took a salary at Tesla. Instead, he got paid in stock options, which went to the moon.
Instead of selling his stock, Elon says to the bank, I own billions in Tesla shares. Can I borrow against them? The bank says, sure, here's millions. And that's how the rich pay interest, not tax, which is far cheaper.
So what we know about Elon is he actually did sell a lot of his shares and paid a huge amount of tax. But this is a strategy that a lot of well-off people will use because, of course, you don't have to pay tax on loan money. I do think that a lot of times this tax benefit is exaggerated. It provides a huge benefit, but at some point, those loans do have to be paid back. So usually what I see is people that are well-off will get a huge benefit from this, but do still have forms of income that they are paying tax on.
Right, but what she didn't tell you is he only paid capital gains tax. He didn't pay income tax. So it's much better to have the loan. I mean, think about it. Interest on a loan, right? If you refi your portfolio, right? So say for example, you're doing the silly old-fashioned thing and you're paying off your properties, right? I know a lot of people are going to comment below and they're going to say, "But Jason, I want my properties to be free and clear." You are out of your mind. They should be free and clear. Okay, so you can have tons of positive cash flow and you're going to pay income tax on that income, right? Versus leverage your properties up, make them perform much better, be in a much safer position. I know it's counterintuitive. I'm not going to go into why it's safer today because I have talked about it ad nauseum. Just listen to the old stuff. I've talked about it on and on and on. And you're going to borrow the money to live on against your assets. There's no tax on borrowed money. That's why it's beautiful. It's a beautiful thing. And in her example, she's saying, well, the example's over exaggerated. Okay, maybe it is. She says someday the loans have to be paid back. Well, not really. They don't really ever have to be paid back because you can keep refinancing them. Elon Musk, in this example, can keep refinancing those stock loans. You, in your example, can keep doing the refi till you die strategy on your properties. The best plan is to constantly equity strip the properties. Let's listen to the rest. Now, this is a tax advisor talking. So whenever you're talking to a tax advisor, you're generally getting a much more conservative view. But what we've learned, if history is our guide, what we have learned through so many examples is that the seemingly more conservative thing is actually the more risky thing.
And for actual tax law from a tax attorney, subscribe.
If you don't have an income, you don't pay any tax. And this is exactly what wealthy people are doing. Elon Musk never.
See, if you don't have an income, you don't pay any tax. So you don't want to get into the income position because that is the highest taxed position. All right. So without any American crew styling cream in my hair, let's do the rest of the presentation. All right. So today, I want to talk to you about some of the mistakes people make when investing in real estate. So we'll get to that in just a moment. It's going to be kind of a review session. You heard me talk about this a very long time ago, but we're going to cover that again with a little bit of a new angle on it. But before we do that, I want to talk about corporate buyers again. The institutional buyers of investment properties, of single family homes, the so-called smart money. And it probably is the smart money. So maybe we should take a cue from them and look at their example. Large corporate buyers' share of the overall purchase market. You can see if you're looking at this on video, I'm showing a chart here that shows you institutional buyers, but also iBuyers. Just a reminder, what is an iBuyer? Well, remember when Zillow had their big disaster a few years ago? They were iBuying. A company like Opendoor is an iBuyer, and there are many of them out there. Redfin does iBuying. I don't know if they're doing it currently. Well, they seem to have an iBuyer program because it's on their website, but they might just be referring those leads out to other people. Anyway, the point is, there are iBuyers out there in the market, and basically what they're doing is they're just buying the properties to usually flip them. And you can see that a lot of times these big corporations just don't do it very well, right? And Zillow got in over their head a few years ago. We all heard about that story. We covered it on this show. But anyway, suffice it to say, the iBuyers. So they're back in the game. They're buying like crazy again. And the institutional buyers, they are way up. So as a percentage of the overall purchase market, what does that look like? Well, for the institutional buyers, about 2.5% of the overall purchase market. Now, remember, that overall purchase market, how do we define that? That includes owner occupants and non-owner occupants. Okay, so it includes the investor buyers, which right now, just a rough estimate, probably make up like 25%, give or take, of the overall buying market. So when you look at 100%, about 2.5% is institutional buyers, and another 2%, give or take, is iBuyers. So about 4.5%, almost 5% of the overall market is corporate players. Now, the other thing we've got to do is define, how do we define a corporate buyer or an institutional buyer? Is it a company? I mean, most of us watching, we have LLCs, we have entities. So technically, if we buy one property and we use an entity to buy it, we are a corporate buyer. We're an institutional buyer, right? Well, a lot of people are defining institutional buyers as those who own at least 1,000 single-family homes. So 1,000 single-family homes or more. Usually they're defining that as the institutional buyer, right? Now here on this chart, we're seeing Freddie Mac define it, and Freddie Mac defines it differently than, say, John Burns, right? So everybody's defining this a little differently. Freddie Mac says 1 to 9 properties is a small investor, and a mid-size investor is 10 to 99 properties, and an institutional investor is 100 plus properties purchased in the last 12 months. That does not mean 100 plus properties overall in their portfolio. It means they purchased those in the last 12 months. Okay, it goes on to say, we did identify second homes via mortgage writers, via Black Knight data, and so we miss all cash second home purchases. So there's just some things to know when you look at this chart, right, as to how they're defining that. Okay, let's move on. So here is the overall investor share of the purchase market. And what we really need to do here more than anything is look at the trend lines, because you see that the bands move kind of up and down here in a range of about 7% of the market, where they'll go from, maybe 30% are not institutional anymore. We're just talking about investors, okay? Investors in general, non-owner occupied buyers. So about 30% will sometimes be investors lately, and then sometimes it'll drop down to 23%, give or take, right? So you see it moves in this band, but look at the overall trend line, and you can see lately it's going way back up again. We're up in the 30% or slightly above 30% range. That number peaked right coming out of the Great Recession, about 2011, where we saw about 35% of the market as investor buyers. But let's go back further, because this just shows you how our wonderful, most historically proven asset class in the entire world, single family investment or income properties, the most historically proven asset class in the entire world for the longest time, right? Not a newfangled thing, a very sure bet, a conservative bet that's been around for a very, very, very long time. I mean, people have been investors for like a couple thousand years. Okay. It's a pretty darn proven asset class. Okay. So, but back just 25 years ago, in the year 2000, this was a much smaller number. It was about 1/3 smaller, or only 20%, give or take, of the market, even dropping down to like 17%, about half of what it is now, give or take, was investor buyers. So you can just see how the trend is catching, how the fever is catching. In the last quarter of a century, everybody has just recognized that the place to be is real estate, income properties. It's just such a historically proven asset class. But way back to the 1950s, there was William Nickerson. Look up his old books. I really encourage you to buy those old books and read them. They're pretty short, and it's just amazing. You hear the numbers, it's like, wait for it. Okay, I bought this house for $7,000 and I sold it for $9,000. Woo! You can't even make an earnest money deposit for that amount anymore, right? It just shows you how proven this asset class is. It's just an amazing, wonderful asset class. So here you see John Burns, Real Estate Consulting, and they're defining the landlords of 1,000 or more properties, right, as institutional buyers. And this is just another graph, another way to look at it. Doesn't include the iBuyers, just includes the buy and hold institutional buyers playing a huge part in the market, a bigger and bigger part. And again, folks, I have said since the beginning, since we've been talking about these institutional buyers, maybe we started really talking about them in about 2009, 2010. I've been saying that this is a good thing that they're in the market. Again, they're not that big a part of the overall market, but their share is increasing. They're paying much more attention to the asset class, and it's a good thing they're in the market because they are much better at raising their rents than we are. And those rents become comps for us. And as they pump rents up, we see our opportunity to ride on their coattails and see higher rents as well. Because tenants get into the marketplace and they bounce around just like, a pinball machine. I know you millennials and Gen Zers don't know what a pinball machine is. It was this thing where it had like a metal ball and it bounced around inside. Yeah. Anyway, it wasn't a video game. It was a physical game. And they bounce around and they see this property, that property. And when they see these institutional investors offering properties for rent, pushing those rents up constantly, every year raising the rents, then that becomes a comp for our rents and it makes us better at raising our rents, as we should be. Our costs go up, inflation goes up. We have to keep increasing rents. Do not be one of these lazy investors with lazy money, with lazy equity that sits there and says things like, I like my tenant, they've been there forever and I haven't raised the rent in 13 years, okay? That is not a good investor. You got to optimize your portfolio all the time. Okay, so without further ado, let's get into some of the mistakes these investors make. Hopefully they're not you. That's why I'm referring to them as these investors. They're not us, right? We're not making these mistakes. Well, maybe we have in the past, but we're not going to make them anymore. I want to talk to you today about the biggest mistakes people make when investing, especially when they are investing in the best investment going still, the best one we can find, and that is income property. These mistakes will apply to income properties, but also to other investments, and really impacts every area of your financial life. So let's just kind of get into these mistakes. There are about 30 of them that I've identified, and I think it's really important that you know what the potential pitfalls, roadblocks, possible downfalls of the investments are so that you can avoid them. Because if you're aware of it, you've already overcome half the battle, haven't you? So let's get into some of the biggest mistakes investors make. And these are, by the way, in no particular order. They're just kind of random, okay? So let's just go with a stream of consciousness here, and let's make sure we are good, prudent investors, and we are avoiding the mistakes that people make out there. Because I'll tell you something, having this practice and managing salespeople for many years now, and dealing with investors and for many years now, and having thousands and thousands of people come through my various educational events, I have heard it all, and I have seen it all. In fact, I rarely hear anything new that I haven't heard before. And that's just kind of the way it is with human nature, isn't it? You know what's interesting about human nature is that it just doesn't really change. I mean, the times can change, the technology can change, the circumstances can change, but human nature is pretty darn consistent. And if you want to know this is true, just read old stuff. I mean, read the scriptures, read the Old Testament, read the New Testament, and you just realize that human nature has pretty much been the same for about 3,000 years of recorded history, and I'm sure it was the same back before that, but gets a little murky in terms of the recording. So, the investor mistakes. What do? Well, the first one I wrote down is that investors don't get out of their own way. And this really applies to a lot of things. We sabotage ourselves sometimes in life, don't we? We engage in the paralysis of analysis and agonize and analyze. And a lot of times we do this stuff really as a self-sabotaging excuse to not do something. There's a great old quote that says, some people have thousands of reasons why they cannot do something, when all they really need is one reason why they can. Okay? This is where people get into the sort of perfectionistic thinking too. And the old quote there is, I would rather see a crooked furrow than a field unplowed. It's better to do something imperfectly than nothing flawlessly. Okay? So you got to get in and get out of your own way and just move. I find that there is a lot of wisdom in movement. And if you're a longtime listener, you might agree with this statement I'm about to make about my self-perception. I think of myself as a pretty analytical person. I really try to look at things from all sides and all angles. And I get in my own way. I do this all the time. It's a self-sabotaging behavior. It's terrible. And what I have found in business, in investing, and in life in general, when I just jump in and do it, that there is a lot of wisdom in just action. Action is wisdom in many ways. Now, the caveat here is that doesn't mean that you shouldn't be the fool that rushes in. You shouldn't just jump in without looking at things from an objective perspective, of course. But don't get in your own way. Don't overthink things, but don't underthink them either. So these all require some balance on your part. So there's the paralysis of analysis. I'll call that number 2. It kind of blends right in with number 1. But the paralysis of analysis mostly stems out of self-sabotage. It stems out of fear. And it stems out of intellectual snobbery, okay? All of us as people, we want to sound smart and we want to think we're smart, have other people think we're smart too, right? But sometimes we do this, and these people, I have seen so many people, especially highly educated people, that education actually becomes a huge disadvantage. And you've heard people talk about this on my show, because this education, instead of opening up opportunities, it focuses thinking and it makes people narrow-minded. The word fear has been turned into an acronym, FEAR, false education appearing real. Or another way to say it is false evidence appearing real. So fear can cause the paralysis of analysis. Did you ever see that movie, by the way? I thought this was a really, it wasn't exactly a deep movie, but I thought it had a good deep life lesson. And it's the movie called Yes Man. Remember that one with Jim Carrey? Well, Jim Carrey's a pretty funny actor, and by the way, I love the movie Liar, Liar, where he's the lawyer. Lawyers, I think a lot of them just lie for a living, so that movie's particularly funny. But in the Yes Man movie, the story is that he was, if I remember it correctly here, I think he was hypnotized, and he had to say yes to everything. And what happens in the movie is that he's saying yes to a lot of really stupid things. The guy at the airport soliciting for a donation, and he just says yes and gives the person all his money. Well, obviously that's stupid. But what the movie shows is that by saying yes, he tends to sometimes do something that appears to be a mistake. And later, through this kind of winding, circuitous route, it turns out to be a blessing. And the advice I would give all of you listening, and the advice I'm giving myself, is to say yes more often. Point number 1 on getting out of your own way that we just talked about. In business, I find that sometimes I'm thinking about engaging in a business deal with somebody or some company, and I just find that when I do things, profits are created. Sometimes it doesn't go right. Certainly, the problems are created too. But the more I do, generally speaking, the better off I am. And the more I agonize, and the more I analyze, and the more walls and barriers I put up, the less happens, and the less rich I become, and the less growth I experience, okay? And I'll bet you that's true in your life. So your homework for that one is do like Jim Carrey, and just try saying yes more often, okay? Number 3, over-magnifying bad experiences and playing down true return on investment. I'll give you an example. Today I went to lunch with one of our investors. By the way, this guy is an old friend of mine. I've known him for a long time, many, many years. And he's been investing with us, and good friend of mine, great person. I will tell you, though, he's indecisive, and it takes him a long time to make a decision. He wants to really analyze everything to death, overanalyzing, I would say. And he's talking to me about how his investments are going, and he's trying to buy another property right now. And at lunch, he kept talking about over and over about how he lost this last deal. And he's upset about it because he had put in an offer on the property and the property sold out from under him. And this happens all the time right now. Now, market conditions obviously change, but he put in this offer and the property was sold to somebody else because he didn't have his offer in quickly enough, agonizing and analyzing. And he wanted to direct the whole conversation toward the fact that he was upset that the agent didn't return his call quickly enough and didn't send him an email fast enough. And I'm like, why are you magnifying all of this? I mean, really, who cares? A lot of this stuff, folks, it's just never going to be right. Nothing is ever going to be just perfect and just right. You got to just jump in with both feet and do things. And if things don't go well, do something else, okay? Look, I'll tell you something. Back in 1999, I published a book called Become the Brand of Choice, a book about personal branding and marketing and how to develop exposure for your business and yourself and so forth and create income through that, which I think is a great idea, by the way. And I coach people on that all the time. And for many years before that, I wanted to publish a book. And I was so perfectionistic about it that I just kept agonizing. Well, what's the structure of the book going to be? Let's do an outline on it. Let's do all of this stuff. And I'm not sure that's the right way to do it. And, I could have published a book years earlier, but I just kept agonizing over it. And I'll tell you something that happened. Now, books usually don't really make you any money. Occasionally they do. But what they do is they give you a huge credibility boost. And if you're a speaker or a consultant, you can really increase your fees if you're a published author, okay? And that happened to me. That was a very good thing for me. But had I just published a book sooner, even if it wasn't perfect, I would have been able to increase my speaking fees a lot sooner than I did. Okay? So just another example of over-magnifying. Here's another way people do it as investors. They'll have a bad experience or a semi-bad experience. Say they've got a property manager that isn't really doing the job for them or isn't super motivated about taking care of their property or getting it leased fast enough. And they'll get on the phone with the manager and they'll talk to them for all of 20 minutes or 15 minutes. And they'll magnify this 15 or 20-minute conversation like it's some big deal. Like, wow, what a hassle. I gotta manage my manager here. Yet they spend their whole life engaged in their job, okay? They spend 40 to 60 hours a week doing their job, which is many times a go-nowhere job, okay, that won't make them wealthy. That's just a means to basically the basics of life, nothing great in life, okay? And their property portfolio is the thing that is really going to create real wealth for them, assuming, of course, they have a good portfolio and they followed all of our other advice, which if they did, they do have a good portfolio. And they over-magnify this little tiny problem that they had, this little discussion they had to have. They're really bugged by it. And something will happen like, oh gosh, my property was vacant for 2.5 months. Isn't that terrible? It's the end of the world. Well, if you looked at the pro forma when you bought the property, or if you're using the property tracker software to keep track of your property, the pro forma return is probably something upwards of 20% annually. That's phenomenal, okay? So say it doesn't go that well. Say you have more vacancy than you expected, or say you have a repair cost, or your manager overcharges you for something, a $25 or $40 overcharge, right? For some reason, some people, and I say this is a self-sabotaging behavior, this is a bad habit, this will keep you from the good life, that's how important it is. They over-magnify these little pebbles, these little pebbles in their shoe, and they make them like they're some big deal. Folks, it's important for us as people to constantly step back from situations, to step back from our life. If you were a painter, right, and you were painting a beautiful painting, would you be looking right up at the canvas where your eyes are 4 inches away from the canvas, looking at the brush on the canvas? Or would you back up and appreciate the whole picture, the big picture, right? hopefully you can see the forest through the trees, as the saying goes. Hopefully you would step back and look at the big picture and keep that in perspective. Because when you don't, and you let these little things bug you, you derail big plans for wonderful things. All right? There's an old saying, and I'm sure you've heard it. Remember, don't sweat the small stuff. Rule number 2, it's all small stuff. Pretty much everything that bugs us in our daily lives is pretty small stuff. Let's not let it derail our big plans, okay? Here's another one. People don't become educated. People spend a lot of time in school. They go to college. They get a degree. They get an advanced degree. And it is amazing to me the perspective people have on education and how completely wrong it is sometimes. Why do I say that? Well, the reason I say it is because the vast majority of the stuff we learn in school, whether it be grade school, undergrad, or graduate school, pretty much doesn't teach us the most important thing. And the most important thing is how to succeed in a world where most people do not. That is the most important type of education. The education that you get here on the Creating Wealth Show, the education that you get in my products, in my coaching program, in my newsletter, and at my live events, is the kind of education that will teach you how to succeed in a world where most people do not. Remember, you don't have to outperform everybody by a huge margin. You just have to do it consistently for a certain period of time, and the effect of that over time is like this. Have you ever looked through a telescope and maybe looked at the moon? I'm sure everybody listening has done that at one time or the other, right? And you looked at the telescope and you were looking at the craters and all of that kind of stuff. You know, it is made of cheese. Just kidding. And you were looking at the moon, and then you accidentally bumped the telescope. And when you bumped the telescope, you were looking out into interstellar, intergalactic space across the universe, right? And that little tiny bump set you off millions of light years into a whole different world, a whole different galaxy, a whole different part of the universe, right? That's how getting the right kind of education and acting on it can change your life over the course of time, okay? So that's very important to do. All right. Number 5, being too greedy. The famous movie Wall Street, right? Remember that? Greed is good. Well, as a fellow capitalist, I actually agree with that to an extent. But greed can also be a self-sabotaging behavior. So it is good to be greedy, in a sense. I'm saying that in a good sense, obviously, not in a malicious or unethical or indecent sense, which it has that connotation, I understand. But it's good to be greedy and want success for yourself and to want to see your financial life grow. But as income property investors, a lot of us can be too greedy in that we try to get a small amount of extra rent, $50 or $100 per unit. And in so doing, we sabotage ourselves because our unit stays vacant for one extra month per year, for example. Well, $50 a month times a year is how much? That's $600, right? So 1 month of vacancy on a unit that rents for, say, $1,200 a month just costs us a lot more. So we need to always keep our greed in check to make sure that we are not actually sabotaging ourselves. Being too greedy and wanting to get that little bit of extra rent, sometimes you can do it. And when you can do it, I say go for it, okay? You definitely want to raise your rents whenever you can, but you don't want to make your tenants move, okay? It's a fine balancing line. And if your property is vacant, don't be too greedy. The most important thing is to get it rented, okay? Number 6, not listening to your property manager. So it kind of dovetails into the other one. Not listening to your property manager. Now, is your rent too high, and is your manager telling you it should be lower? Is your rent too low? Is your property manager telling you it should be higher? That's why you have us. That's why you have your investment counselor to help you determine that and to get a second opinion when you have a property that you might be struggling with. I know it happens from time to time as market conditions change. You can always call an investment counselor here and you can bounce it off of them. We keep our finger on the pulse currently of 42 markets nationwide. Okay? So we are an impartial, objective opinion. Number 7, here's the corollary to that. Listening to your property manager. That can also be a mistake. I just don't know of any other better way to say this. You have to balance this out with your own intelligence, and you have us here to bounce this off of and get a second opinion from. So it can be a mistake to not listen to your manager, and it can also be a mistake to listen to them. Use your own judgment, bounce it off of us, and we'll be happy to help you. So a lot of times you can easily raise the rent. Ideally, in a good environment, you can raise your rents 4% per year. So if you have a unit that's renting for $1,000 a month, you raise your rent $40, which is 4%. Now, there are many factors that come into play, and we've talked about them in prior shows, and we can coach you on this, and our live events, we talk about this too. I don't have time to go into it here, but there are many factors in a marketplace that affect rents, interest rates, the rental market, the competition, all sorts of things. But generally speaking, on renewals, you as the owner managing your managers needs to push them to raise the rent. Okay? Next big mistake investors make. Not having an investment counselor. Not having someone who is area agnostic like we are. Okay? When you go directly and you talk to brokers or sellers or banks that have REO or foreclosure inventory in a certain market, you're not getting a very objective opinion, are you? No, you're not. When you go into a stock brokerage firm, a Wall Street type firm, Merrill Lynch, Ameriprise, whatever, all of these companies are basically wanting to sell you mutual funds, stocks, and bonds. And I ask you, how many people do you know who created any real wealth out of the products like life insurance, annuities, stocks, bonds, and mutual funds that are sold at these Wall Street firms? Well, I don't know anybody who got rich doing this. Okay? And I'll bet you the person sitting across the table from you didn't get rich doing it either. The way they got rich is by selling that junk, those mediocre financial products. Hey, this is just my opinion. Okay? Those mediocre to lame financial products, they got rich selling those to unsuspecting people like you. See, the people that get educated, that go out and do their own thing, okay, that control their own investments, those are the people that get ahead in life. Well, all of the lower and the middle class investors, they just give their money to some money manager, okay, that doesn't have their interest at heart and has a total conflict of interest in so many ways that I've discussed before. Okay? So have a professional investment counselor. Work with a company that practices what they preach. I've been an investor for decades. Okay, I've made millions of dollars investing. I am a person that has actually been there and done that. You can listen to me because I have cred, as they say. You know, the kids, they say, do you have cred? Yeah, I've got cred. Okay, I've got the street credibility because I've done it myself. Okay? Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.